Robert Kiyosaki's advice just cost you your entire savings. While millions treat Rich Dad, Poor Dad like a financial gospel, the reality is that its most famous strategies are actively destroying modern portfolios. You think buying assets is the golden key, but in today's volatile market, those same assets are becoming liabilities that drain your accounts dry. It is time to dismantle the dangerous myths hiding inside this best selling manual for disaster. And the last point I have for you today: it is the one single mistake that has caused more people to lose their savings than any other. And it is something Robert Kiyosaki rarely talks about in his seminars. So sit back, get comfortable, and let us break this down properly. To understand the man, you have to look at the numbers. When Robert Kiyosaki published his book in 1997, the financial landscape looked nothing like it does today. The internet was in its infancy. The housing market had not yet seen the collapse of 2008, and the concept of a passive income stream was still considered a fringe idea for the average worker. He sold over 40 million copies. He built a global brand that turned financial literacy into a household conversation. That is the first thing he got absolutely right: the psychological shift from being an employee to being an owner. He taught millions of people that a job is not a wealth building mechanism, but a survival mechanism. That distinction is vital. Think about your own situation. If you rely on a single paycheck, you are vulnerable to forces you cannot control. Whether it is a corporate restructuring, an industry shift, or a global recession, your security is tied to the decisions of someone else. By shifting your mindset to look for assets, things that put money in your pocket while you sleep, you reclaim your autonomy. I have a friend who used this logic to start a small vending machine route while working a retail job. It started with 2 machines in a local warehouse. Within 3 years, he grew that into a network of 40 locations. He did not need a high-paying corporate salary to start. He needed the mindset to recognize that cash flow was the king of the game. That is the foundational victory of the Kiyosaki philosophy. It forces you to look at your bank account not as a bucket to be filled by labor, but as a garden to be cultivated by assets. Now, let us move to the level up. This is where the story gets more complicated. Kiyosaki is famous for his distinction between assets and liabilities, but his practical advice often leans heavily into the world of real estate and debt. He famously argues that your primary residence is a liability, not an asset, because it takes money out of your pocket every month. Technically, he is right, but he often glosses over the extreme risk inherent in the way he suggests you acquire those assets. In his view, using leverage, otherwise known as debt, is the only way to build real wealth quickly. And this is where millions of his readers have run into serious trouble. The 1997 version of his strategy works beautifully in a rising interest rate environment or during an economic boom. But when you apply that same logic during a credit crunch or a market correction, you are effectively playing with fire. Consider the cautionary tale of the real estate investors who went all in on commercial property in 2022. They followed the leverage is power playbook, signed on variable rate loans, and watched as their debt service costs tripled in less than 18 months. Those properties were theoretically assets, but because they were financed with high interest short-term debt, they became toxic liabilities almost overnight. If you are finding this breakdown helpful, hit subscribe. I analyze these financial frameworks every week so you do not have to learn the hard way. Now, let us talk about the one part that really matters, the part I have been saving for you. The biggest critique of Kiyosaki is not his definition of assets or his love for real estate. It is his complete dismissal of the most powerful wealth building tool available to the average person: the boring, unsexy, consistent index fund. He often frames the stock market as a rigged game controlled by insiders and Wall Street sharks. He is not entirely wrong about the market being manipulated, but his conclusion, that you should ignore it, is mathematically disastrous for the average investor. Here is the data. A study by Vanguard found that over a 20-year period, a low-cost SP 500 index fund outperformed more than 80% of active stock pickers and private real estate syndicates after accounting for fees and taxes. That is a massive percentage. Think about the effort difference. Kiyosaki's approach requires you to become a full-time real estate expert, a tax strategist, and a property manager. The index fund approach requires you to set up an automated contribution of $500 a month into a diversified fund. That is it. You don't get the thrill of the deal. You don't get the adrenaline of flipping a house. But you get the compounding power of the entire global economy. By ignoring the power of low-cost passive index investing, Kiyosaki's philosophy actually discourages people from the only strategy that has been proven to build wealth for 99% of the population. He makes investing sound like an elite sport that you have to master to succeed. In reality, it is a game of patience and automation that anyone can win if they just stay the course. Let that sink in for a moment. If you spend all your time trying to be the next big real estate tycoon based on outdated 1990s tactics, you might miss the quiet, compounding growth of a boring index fund that could have made you a millionaire by the time you retired. It is a classic case of chasing the shiny object while ignoring the proven path. So, where does that leave us? Robert Kiyosaki gave us the gift of a mindset shift. He gave us the vocabulary to talk about money differently, to identify the difference between an asset and a liability, and to question the traditional education system. That is an incredible foundation. But the execution he suggests, you have to treat that with caution. Do not blindly follow the leverage everything advice unless you have the capital to survive a total market collapse. And for heaven's sake, do not think you are too smart for simple, boring, long-term index investing. It is the boring stuff that actually builds the kingdom. If you found this breakdown useful, share it with someone who is currently deciding how to start their financial journey. It might save them from a few very expensive mistakes. Subscribe so you do not miss next week's video, where we are going to break down the actual math behind how to retire 10 years earlier than your peers. I will see you then.